Hey everyone, it's Conrad Bobulak here, author of Australian Property Finance Made Simple. And today's video, I want to share a very interesting topic with you on how to invest in Australian property and how to create an income, a passive income for life. The biggest misconception that most people have when starting out in real estate investing in Australia is they actually think they're going to live off the rentals of their properties. I can tell you now, being in real estate for 20 years, having managed a mortgage broking company and working in banking, most successful investors do not live off the rental of the property portfolio, they live off the equity. And I'm going to show you a very simple system on how you can replace your income and generate $60,000 per year passive income for life, simply by owning and structuring your property portfolio correctly. So which is really cool. So if you're interested in that topic, stay tuned and I'm going to explain everything in this very short video. Now, why should you listen to me? Because a lot of people have opinions about how to create wealth and how to invest in real estate. And a couple of things that I want to mention to you, apart from having all the credentials behind my name, being a real estate agent and being a mortgage broker and having worked in banking and finance, the most important thing is that I'm actually a successful property investor with a multi-million-dollar property portfolio, and I've retired living off my property portfolio. So I've actually been there and I've done that. And that's the only thing that really qualifies me from teaching you guys how to do the same thing. In my opinion, I would never take any advice from anyone who hasn't achieved exactly what I want to achieve. And that's why there's a lot of these so-called experts out there in the industry. Most of them are academics. They've done a bunch of degrees. They have a very strong opinion about what the market's doing, where it's heading. And the reality is most of them don't actually have any investment properties behind them. So to me, theorists are worth nothing. It's all about practical application. If you want to get a copy of my book, a lot of the topics that I'll be discussing in this video are covered in my book. And for those of you who haven't had a lot of experience with finance, a lot of the terminology and methodology used in finance might seem hard at the beginning. And I'm going to clarify some terminology in this video. But for those of you who want to go to the next level, definitely get a copy of my book on finance, which goes through the basics and you end up at a very high level of knowledge just by reading the book. $32.95. But if you go to that website, Book on Finance or Amazon, or you probably get it on eBay for 10 bucks. Also, what I want to do is, just as a reward, at the very end of this video, I want to give you access to 10 hours of free online real estate investing home study, which explains what I'm about to explain in extreme detail. So if you're interested in furthering your education, which I think would be crazy not to, this DVD or video online home study is absolutely free, no strings attached, normally valued at $497. So stay tuned to the very end and watch this video because I'll give you the exact URL where you can go in, register and get access to the video home study, plus a 265-page manual that you can download and you can follow all the PowerPoint slides. Now, property investing is a lot like playing Monopoly, if you think about it. And I'm sure many of you have played Monopoly in the past. The thing about Monopoly, is it a short game or is it a long game? It's a very long game, isn't it? It usually takes half a day, especially if you play it correctly with 4 people. And usually 2 of those people, or maybe 3, get very angry at the end because they end up losing everything and one person collects all the money. And the ultimate goal of Monopoly is really to control Mayfair and Park Lane. And it's to control commercial real estate on these 2 properties, if you like. Why? Because if you land there, you're probably paying the person $1,500, $1,600, $2,000. It's funny, there's a lot of lessons in Monopoly that you can actually take into the real estate market. What I don't understand as an agent, as a property investor, is why people think they can become wealthy by investing in Old Kent Road and properties that are cheap, around the $50,000, $60,000 mark. There's a saying in real estate, cheap today, cheap tomorrow. And there's a lot of truth behind that. So if you want to win the game, you really got to focus on investing in blue chip areas and controlling as much property in those areas as possible. Now I know what you're thinking, yes Conrad, but it's very expensive to invest in those areas. Well, you might not be able to buy a house in there, but you definitely can buy a townhouse or an apartment. That's the reality of the situation. Or you can go out in regional areas and buy a lot of houses for 50 grand and then deal with all the headaches of maintaining those properties. But hey, that's just my opinion. At the end of the day, the whole objective of real estate investing is to sell up everything and count the money, which is kind of like Monopoly, playing Monopoly. The person that wins is actually the one who sells everything up, counts all the money. Now in real estate, you don't need to actually sell everything. Okay, that's one strategy, is to sell everything and put the money in your bank account and live off the interest returns. Or you can, there's actually a number of ways you can retire from your property portfolio. You can buy 12 properties, sell 7, pay off the other 5, can be debt free with unencumbered assets. The most common way is to live off the equity, which I'm about to show you in this video. The least common way is live off the rental income of your properties, okay? And this is what the misconception is for a lot of people out there, that you're actually going to be living off the rental income. The rental income, it doesn't give you a lot of money. It gives you enough money just to keep buying more properties and to service future debt. That's the reality of the situation. Now, before we get into it, I just want to cover 4 critical parts of building a large property portfolio that you might not be aware of. Part number 1 is you've got to cultivate the right psychology. And this is perhaps the hardest thing to do when it comes to property investing. The difference between successful property investors and unsuccessful a lot of the times is pure mindset and psychology. If you haven't got that mindset and psychology, you're going to struggle to build a large property portfolio. Number 2, excuse me, is developing the right plan and system specifically relevant to you as an investor. You know, there's no good you looking at someone else's plans and trying to copy them. You can copy the methodology, but you can't copy the actual plan, because everyone listening to this video has a different risk profile. You've got different amounts of years left for you to invest. You've got different amounts of access to equity and serviceability, and you've got different levels of financial literacy, how comfortable you are with crunching numbers. And those things ultimately will determine where you should be investing and how you should be investing and which strategy you should be focusing on. What I mean by that is, if you're really conservative and you're scared of looking at numbers and you don't understand Excel spreadsheets, you know, and you're kind of risk adverse, then buying blue chip properties in major capital cities and just buying and holding them is probably the way to go. If you're comfortable with numbers, you've got a bit of equity and time behind you, and you're very comfortable taking some level of risk, then maybe property development is the way to go, or doing subdivisions. You know, so you can take more risk and you obviously get a higher return for your actions, but that's something that's perhaps you might consider. So different people have different approaches. There's no right or wrong here, but there is a general blueprint that you can follow, especially when it comes to structuring a property portfolio, which I'm about to show you. Number 3 is you've got to have a team of experts around you. And this is one of the most important things that I can show you during this video, and stress the fact that if you don't have the right accountant, the right mortgage broker or banker, and the right solicitor, you can really make a lot of mistakes in real estate, especially with structuring your property portfolio. This is why 72.8% of all investors own one property. I believe they buy the wrong property in the wrong structure. You know, most people have no financial literacy, they're scared of investing, and they get bad advice. So getting a team on board and assembling a team of experts around you will almost propel you to the next level. I mean, these guys, if you've got the right team, won't actually allow you to make a mistake. Number 4 is understanding property selection methodology, knowing which property to buy in which area and when, and that's a very important thing. Now, a lot of this stuff is beyond the scope of this video, okay? I've made other videos on these topics, but I just wanted to make sure that you understand these are the critical parts of building your property portfolio correctly. And when all these things are synchronized, that's the very definition of success. When these things are not synchronized, you're going to struggle getting success. And a lot of people sometimes don't get to where they want to be when they're building large property portfolios, and they struggle, and it's usually one of these things is out of whack in the whole picture. I've done other videos just on this particular slide. In fact, I've got a book that I'm writing, book number 3, which actually covers these 4 things in a lot of detail. So if you're interested in that, stay tuned for my 3rd book that's coming out. If you're looking at property investing, you know, Melbourne is probably the best market in Australia to invest in for buy and hold long-term capital gain. Based on Domain 2016 figures, if you look at the national top 20 suburbs in the major capital cities in Australia in terms of the best performance over the last 10 years, Melbourne has 16 out of 20 suburbs as the best performing suburbs. Many of our suburbs are hitting 11, 10 and 9% capital growth consistently every year for the last 10 years. And a lot of these suburbs will continue to do the same in the next 5 or 10 years. The key thing is you just got to know which ones are doing what. And that's the hardest thing when it comes to investing. If you look at the median price in Melbourne, in 1966, it was $13,000 for a detached house. And then in 1976, $37,000. And then in 1986, 83,700. In 96, 144,000. 2008, 432. 2014, 607. Now, 776,000. It just keeps going and going and going. Yes, there are periods of time when the market goes sideways, even down. But if you have a buy and hold, long-term, never sell, objective or a strategy, it's virtually impossible to lose money as long as you pick the right area. And I must stress that. There are 316 suburbs in Melbourne, only 45 are worth investing in, okay? So you've got to choose the right areas. Let's go through some industry jargon, because a lot of industry jargon in this whole thing, I think a lot of it is unnecessary, but I just want to cover some of it because a lot of it is just jargon that we've got to get out of the way. Now, for those of you who haven't got a lot of experience with finance, I encourage you to buy my book because it goes through virtually all the terminology used in the industry and it's going to make your life a lot easier as a property investor. What I want to cover today is loan to value ratio. A loan to value ratio, LVR, is one of the most common terms used when it comes to property investing and structuring your property portfolio. And what it is simply is the mortgage amount divided by the value of the property times 100. That's all it is. So if you look at a property, let's say for example, a house with 600,000, you've got a loan of 200,000, and then you have equity of 400,000. To work out the LVR, we simply take 200,000 divided by 600,000 times 100, which equates to LVR of 33.33%, or LVR I should say, not percent, which is a very low LVR. It's a good position to be in. Okay, so that's what loan to value ratio means. Now, equity is the amount of money you can access in your property. And there's different types of equity. There's just equity position and there's accessible equity as well. Equity being the current market value of the property minus outstanding mortgage. So in this example, if you look at the house we looked at before, you've got a property worth 600,000, you have a loan of 200,000, and then you have equity of $400,000. Very simple, right? Which is an LVR of 66.66. However, that's not the accessible equity that you have. If you take out a line of credit, and generally speaking, you can borrow up to 80% of the property without lender's mortgage insurance. 80% of 600 is 480,000. Less the debt that you have on the property, which is 200, the amount of property that you can access, or the equity that you can access in this, is actually $280,000. Okay, a line of credit. When you think of a line of credit, think of a giant credit card secured against the equity of your property, generally speaking up to the 80% mark. So it's basically taking out money against your property, okay, where the security is your property, and once that money is taken out and put into an offset account or any account, it is accessible by you. You can spend that money on anything you like, holidays, cars, buying investment properties, renovations, whatever you like. Generally speaking, the line of credit is secured up to the 80% mark of your property, or the 80% LVR. You can go higher, but you just got to pay lender's mortgage insurance. Now, the retirement system that I'm going to teach you today in this video only works if you have a line of credit secured against each property and you have a trust. So each property settles in a trust. If you have a redraw facility and you have properties in your own personal name, you cannot retire using this system. Okay? Now, bankers will tell you that a line of credit and a redraw facility is the same thing. It's not the same thing. It is nothing like each other. Lines of credit have interest capitalization built into them. That means if you draw money out of a line of credit, you don't need to make any monthly repayments. If you don't make monthly repayments, it simply takes the interest out of the balance that's left over in the line of credit. With a redraw facility, if you take money out, you have to physically make repayments every single month. That's a huge difference in what I'm about to show you. So if you are wanting to set what I'm about to show you up, which is basically to retire on a passive income of 60 grand a year, this will not work with the redraw facility, okay? I just want to stress that from day one. So if you go and set up redraw facilities, you cannot do what I'm about to show you, okay? And basically what I'm showing you is what I do with my clients. What I've done myself is to secure 10 properties over 10 years. And this is what it looks like. And the reason it's kind of all over the place is because you never know when you're starting out which property you're going to be buying when, and which line of credit you're going to be setting up against which property to buy your next property, because it's virtually impossible to predict. And it doesn't make a difference, because the most important thing is that you start and you build your wealth one property at a time. That's the key thing. And you know where you're going, which is 10 properties. In between is just the how. The how's easy. The why and the outcome is the key thing to lock in. And once you lock in your destination, you will know what to do next. Now, there are 3 phases of the retirement system. There's a building stage where you're learning a lot of stuff, you're assembling your team, you're working out which properties to target, and you're developing your plan. This is the hardest stage. This is where most people fail because there is a lot of work required at this stage. Number 2 is when the whole thing's already humming along and you're buying a bunch of properties, and then you have a consolidation stage where you're reviewing the performance of your properties. Some of them maybe haven't performed as well as you thought, others have underperformed, others have done better than you thought, so you might want to sell down some of the worst ones and buy in the better areas. And then eventually number 3 is harvesting stage, where you're unlocking equity from your property portfolio and actually living off your equity, which I'm about to show you how that works. Now your plan will vary depending on your risk profile. What's your risk profile? It's how many years you got left to invest in, how much equity you have, how much time, and your financial literacy, your level of understanding finance and the ability to get your head around this whole thing. That's basically your risk profile. So let me just show you a retirement system with just buying 4 properties over 10 years. Let's forget about 10 properties over 10 years. Let's just focus on 4 properties. And 4 is just easy. I mean, I've got clients doing 5, 6 in the first 12, 16 months. So year 1, you buy a property. Year 2, you buy a property. Then you have a break in year 3, 4, and 5. And then year 6, you buy another property. And year 7, you buy another property. It's very basic. You use the equity from these properties, providing you've purchased correctly, to secure these properties over here. Now, what I want to show you is, I want to show you the mechanics of how you get equity out of your property portfolio, how to live off the equity, okay? Now, what I've done here is, I haven't included any capital growth in this example. Obviously, in year 1, if you buy a $500,000 property, that same property would be more in year 2 because there would have been at least 6, 7, 8, 10% growth. In this example, I have purposely taken out any growth or compounding because what I want to do is show you the mechanics of taking the money out of your property portfolio. And the moment I have compounding or capital growth included, I get dollars and cents and the whole illustration would be lost. The purpose of this actual illustration will be too hard to grasp. So you're buying 4 properties over 10 years. In year 1, you buy 1 for 500, year 2, year 6, and year 7. Now, if you've purchased correctly and you've identified the right areas, which as I mentioned before, there are only 45 suburbs in Melbourne out of 316 that you should be focusing on. If you've done your homework correctly, that property will double in year 11 to $1 million. Now in year 11, you refinance that property at 80%, which means you have $800,000. The $800,000 consists of 2 loans. Interest-only loan of $500,000, which you originally took out, and a line of credit of $300,000, which is simply an interest-only loan secured against the equity of your property up to the 80% mark. And the property is worth $1 million. So over the period of 10 years, if you've secured 4 properties, you effectively have created a system where you have 4 lots of $300,000 in a line of credit, which equates to $1.2 million over 7 years. Not bad. Now remember the most important thing, a line of credit is a loan, it's not income. Therefore, it is tax-free. Well, it's not tax-free, it's actually tax-exempt completely because it's a loan. So you can take equity out of your property, spend it on your life, go for a holiday, buy a car, buy other investment properties. The most important thing is that income or that money that you take out of your equity from your property is not taxable income because it's not income that you derive from a job or an income generating activity. So effectively, 4 properties over 7 years, or if you like 4 properties over 10 years, will give you 4 lots of $300,000 lines of credit. And eventually when the property goes from 1 million to 2 million, this is your new line of credit facility, which is 800,000 times 4. So you can continuously create new lines of credit and revalue your property portfolio and live off your equity. Now, if you look at 300,000 times 4, that's 1.2 million over 10 years. 1.2 million over 10 years is 120,000 per year. Okay? Now, you can spend, if you take that 120,000, you can spend 60,000 per year on your life and use the remaining 60,000 to capitalize the interest for the next 10 years. Because remember, if you have 120,000 and you draw 60 grand out, you've got to pay interest on that 60,000. Now let's say your interest rate is 5% per year. So what's 5% on 60,000? It's $3,000. So how many lots of 3,000 do you have in the remaining 60,000? Lots, definitely more than 10 years, right? A lot more. That means you can take 60 grand out tax-free and then capitalize the interest for the next 10 years. Now what happens after 10 years? You revalue the property and increase your line of credit, and you capitalize the interest and live off the equity again. And you keep doing so over and over. Now $60,000 tax-free per year is the equivalent of approximately $100,000 per year before tax. So for properties, the right properties in the right structure with the right line of credit can enable you to replace your income for most people, or add to your income, you know, and live off $60,000 per year tax-free, which is really cool. Must be structured through standalone, do not cross-collateralize your property portfolio, through lines of credit and trusts, otherwise it's not going to work, which is pretty cool. I mean, 4 properties over 10 years, it's easy. You know, I've done 4 properties in the first 12 months with clients. Now, there's 3 ways you can live off your equity in your property portfolio. Number 1 is you can live off your line of credit, which is what I've done myself. I've capitalized the interest, live off the line of credit, take years of work. You can also use your line of credit for trading shares or investing in annuities or shares that pay dividends, etc. Or, you know, you can sell a portion of your properties, sell the worst ones, pay off the best ones. You might have a goal that in 10 years from now, you want to be completely debt-free. So you might say, well, I want to secure 12 properties, sell 7, allow for capital gain tax, and pay off the remaining 5. So if you secure 5 properties, and let's say in 10 years time they're worth $1 million each, that's $5 million worth of unencumbered properties. At rentals of 4%, you're on $200,000 per year. And that's a strategy that's very valid for a lot of people. Secure 12, sell 7, pay off the other 5, which is pretty cool. Let's go to the next level. Because I know if you're listening to this video right now, you say, Conrad, 4's just not enough for me. I want to go to the next level. I don't think I can manage to live off 60 grand tax-free every year. And I know exactly how you feel, okay? So let me take you to the next level and show you a 10-year fast-track retirement system. And I teach this at my live events all around Australia, and now only in Melbourne, on how to actually put this in motion and how to get the team together to put this system in motion. Now this is what it looks like, okay? And like I mentioned before, you never know when you start off with which property you're going to be leveraging against to buy which future property. But the most important thing is you've got a system in place and the methodology that's going to enable you to do this. And this is what it looks like buying 1 property every year for 10 years. Now, once again, as I mentioned before, I haven't allowed any compounding of capital growth here. Yes, obviously the property in year 1 would double in value in year 10. So you can't buy the same property for $500,000 from year 1 to 10 because it's going to be virtually half the value of this property. I understand that. I'm simply showing you an example to show you how the line of credit works in a very simplistic way. So please don't email me, okay, about the fact that you can't buy the same property every year for $500,000 because every year goes up in value. I understand that, okay? So once again, the property in year 1 goes to $1 million and eventually $2 million. These are your lines of credit. $300,000 every year. Now it's not going to be exactly 300 grand every year, you know? It's not like you're going to get up on the 1st of January every year. You're going to have 300,000 magically there because your property has gone up exactly by 10%. Okay, I'm just averaging out over 10 years. Some years you get more equity, some years you get less equity. You know, we have property cycles obviously in Australia, but this is how it works in theory, and in practicality, it's very close to this. Okay, just some years you're going to have more equity, some years you're going to have less equity. And if you do that, 300,000 in lines of credit over 10 years is $3 million over 10 years, which is 300,000 per year. Once again, you spend 150 grand a year, tax exempt, and you use the other 150,000 to capitalize the interest for the next 10 years, which is 150 grand tax-free per year is the equivalent of approximately 250 per year tax before tax, which is pretty cool. Most people would exit the work industry and pull the pin on the rat race, or at least go part-time in a massive way, if they could generate 250 grand before tax or 150 after tax per year. I know I would. And you can structure this via standalone lines of credit. So you have to do this through standalone lines of credit, through trusts, okay? Otherwise it doesn't work. Now, to do this, it's like a recipe, okay? It's simple, but it's not easy. You've got to have the right team, you've got to have the right methodology, you've got to have the right account and the right mortgage broker, otherwise this will not work. And you know, this is what it looks like over 10 years. And I can teach you this, guys, because I've done this myself. I've retired from working as a financier for NAB, and I lived off my property portfolio, and I've capitalized the interest for years living off my equity. So I know this works because I've done it myself, and that gives me the right to teach you this information, which is pretty cool. The reality is when you start off, like in 2015-16, you never know which equity you're going to be drawing out from which property, because no one's got a crystal ball. Even if you buy in the right area, you've done all the research, okay? And you bought a property, for example, in 2016 in Hampton. There's no way you can tell me that Hampton's going to go up by exactly 10% in the next 12 months. You know, yes, on average, over 10 years, Hampton will do 10%, but some years you'll do 6, some years you'll do 15%, you know. So what I'm saying is, at the moment you start this, there's no way of you knowing in the future where the equity is going to be coming out of to buy which property. And this is exactly what my property portfolio looks like over the last 10 years. I mean, it's just all over the place in terms of equity, because there's no way that I could have predicted some of these areas and some of these suburbs and what they've done. Some properties that I've purchased have done exactly what I thought they'll do. Some properties that I've purchased have underperformed completely. I thought they'll do better. And some properties that I've purchased have gone through the roof, and I can't even explain why they're worth so much, you know. But overall, my whole property portfolio is getting capital growth of in excess of 11% per annum, you know. But some underperform, some hit 11, some overperform. In fact, the more properties you have, the less risk you have, because it's almost like you're insuring your own property portfolio, which is pretty cool. So, question is, what will money do to you? Money is a magnifier. So whatever you are today, money will just magnify you and take you to the next level. You know, if you're a good person doing a lot of charity work, guess what? With more money, you're going to be doing more charity work. If you're a bastard, you're going to become even bigger bastard. If you're a tight ass, you're going to become bigger tight ass. That's the reality of money. Money doesn't change you. Money is a magnifier for who you are already. So once again, how do you live off your property portfolio? There's 3 ways. One is live off your line of credit to capitalize the interest. Number 2, use your line of credit to trade shares or buy annuities or manage funds that give you an income or a distribution. Number 3, build up a large property portfolio, sell a portion of it, pay off the best ones, and live off the rental income. Which one you choose, it's purely up to you, you know? And this is the thing. There's no right or wrong here, guys. There's just options. The most important thing is that you get started. You know, the hardest thing about investing, guys, is to get started and get started correctly. If you get started incorrectly, you're not going to get there. That's the reality. So let me ask you something. Are you interested in learning more? I hope you learned a little bit about, you know, investing in this very short video. If you are wanting to take your education to the next level, there's a couple of things that I want to share with you. Number 1 is I'm running live events in Melbourne called the Real Estate Investing Fast Track Weekends. These are very limited events. They are limited in terms of numbers that I run per year, and I restrict these to 40 seats per event. So there's only 40 people per event. They're live here in the office in Melbourne, and these are some of the speakers that we have. We've got Stephen Molnar, who's the MC, and he talks about investment property and finance strategies. Stephen actually used to own the bank, which is quite amazing. You don't meet too many people that own the bank in Australia, but he's got a wealth of knowledge. He'll be the MC for the day. We also have Martine Angelique, Director of Savvy Accounting Solutions, and she's been in real estate for decades. She runs an accounting practice, and she specializes in educating people about buying investment properties in trusts and corporate trustees versus your own personal name. Cameron Fisher from Changing Places Real Estate and Director of buymyplace.com.au. Changing Places Real Estate is a property manager, management specialist, and also Cameron is a valuer, and he's done over 5,000 successful auctions over the last 30 years in Melbourne. So he's a walking encyclopedia, wealth of knowledge on the property market. Stephen McClutchy from Loans Australia has settled over $1 billion worth of investment loans, which is a crazy number when you think about it. 1,000 million. 1 billion. That's a huge number of 1,000 properties. I mean, at least, it's huge. And myself, I'll be the main speaker for the 2 days. It's a really cool event. It's right here in our office in St Kilda. Check the dates just by going to this website here. Day 1 is in the classroom environment. We spend all day on finance and just pure education, structuring your property portfolio correctly. Day 2, we put you on the bus, take you out of the classroom environment, and we go out onto the streets of Melbourne and we educate you about good areas, bad areas, property cycles, right down to demographics and looking at specific properties and educating you about what to avoid and what to focus on. The most important thing about this event is there is nothing you can buy at the event, there is no property being sold, and there is no upsell, okay? So it's purely an educational event. And that's why seating is so strictly limited and we only run a handful of these per year. Also, if you can't fly to Melbourne, there's a couple of things you can do, okay? Number 1 is get a copy of my book, which is Australian Property Finance Made Simple. You can order it online by going to bookonfinance.com.au and get a bunch of freebies, or just go to Amazon, or go to eBay and get it for $10. Now, as a special bonus for everyone who listened to this video and you stayed to the very end, which is cool, and I commend you for doing that, I'm going to give you access to a special home study which is valued at $497. And this is a recording of the Real Estate Investing Fast Track Weekend from 2 years ago. And it's absolutely free and it's yours. And it's, I go through pretty much everything I went through just before, but in extreme detail. So if your goal is to replace your income and retire by living off your property portfolio, this is an essential piece of information you must have access to. It's very user-friendly. It's 10 hours of contents, plus you get the manual. This is the actual home study page that you can log into, and it's as simple as clicking onto the video and opening up the manual and following the 360 PowerPoint slides that I have through the 10 hours of education. It's absolutely free for you to access, no strings attached, and all you got to do is click on this link or just scroll down below. There's a link below. Just register your details and you can access that information right now. And once again, it's 10 hours of contents plus a 265-page manual. The information here is priceless. It took me over a decade to learn and accumulate, and I've condensed everything into this 10-hour home study. I hope you guys like the home study. If you do, please give me positive feedback. Send me an email telling me how much you enjoyed it, and feel free to send it to your friends and family. And that's about it from me today. So once again, thank you for your time. This is Conrad Bobilac, and I'll see you on the inside.